Before we begin, please remember that I am not a licensed financial advisor. The content in this video is for educational and informational purposes only and should not be considered financial or investment advice. Investing involves risk, including the potential loss of principal. Always conduct your own research and consult with a qualified financial professional before making any investment decisions. You open your 401k statement, and your eyes immediately glaze over. You see a list of names that sound like they were generated by a supercomputer: Fidelity Blue Chip Growth K6, Vanguard Total Stock Market Index Admiral, T. Rowe Price Mid Cap Value. You know your money is in there somewhere. You see the balance and you hope it's gone up. But if someone asked you, what do you actually own? Could you tell them? For millions of Americans, the honest answer is no. Your retirement, your family's future, your biggest financial goals are all tied up in this thing called a mutual fund. But it feels like a black box, a mystery you're just supposed to trust with your life savings. And that feeling of not being in control of your own money is one of the most stressful things in modern life. But what if I told you that not understanding this black box is costing you more than just peace of mind? Imagine two people, let's call them Sarah and Tom. Both are diligent savers. Both put $1,000 a month into their company 401k for 20 years. They have the exact same options available. Sarah, feeling overwhelmed, just picks the fund with growth in the name because it sounds good. Tom takes 30 minutes, just 30 minutes, to understand the fundamental difference between four basic types of funds, and he builds a simple, intentional mix. Fast forward 20 years. Sarah has a respectable $490,000. Not bad. But Tom? Tom has over $700,000. That's a $200,000 difference. The price of a house. The cost of sending kids to college debt-free. The freedom to retire 5 years earlier. What was the difference? It wasn't luck. It wasn't some secret stock tip. It was simply understanding the language of his investments. That is the power we are unlocking in this video. My promise to you is this. By the time you're done watching, that confusing list of fund names on your statement will no longer be a mystery. You will have the decoder ring. You will be able to look at almost any mutual fund and, in seconds, understand its core purpose, its risk level, and whether it's right for you. We are going to strip away all the confusing jargon and give you a simple, powerful framework for understanding the four main types of mutual funds that make up 99% of the investment world. This isn't about becoming a Wall Street guru. This is about taking back control. It's about turning confusion into confidence and anxiety into a clear, actionable plan for your future. So let's start with the absolute basics. What on earth is a mutual fund? Forget the textbook definitions. I want you to think of a mutual fund as an investment potluck. Imagine you want to host a huge dinner party with 100 different dishes, but you only have the time and money to cook one. It's impossible, right? So you invite 99 of your friends. You each bring your best dish. You bring your famous lasagna. Someone else brings a great salad. Another brings dessert. At the end, you don't just get to eat your own lasagna. For the price of one dish, you get a small piece of everything on the table. You get instant variety. A mutual fund is the exact same concept, but with money and investments. Instead of you trying to buy individual shares of Apple, Google, Amazon, Johnson & Johnson, and hundreds of other companies, which would cost a fortune and be a full-time job to manage, you pool your money with thousands of other investors. You're all chipping into this big potluck. A professional chef, in this case a fund manager, takes that giant pool of money and goes shopping. They buy hundreds, sometimes thousands of different stocks, bonds, or other assets, creating a diversified portfolio. When you invest, say, $100 into that fund, you're not buying one single stock. You're buying a tiny slice of that entire massive, professionally managed portfolio. You own a little piece of everything. This simple idea solves three huge problems for the average person. First, instant diversification. The oldest rule in investing is, don't put all your eggs in one basket. If you only own one stock and that company goes bankrupt, you lose everything. But in a mutual fund, you own tiny pieces of hundreds of companies. If one or two of them have a bad year, it's cushioned by the success of the other 98. It dramatically reduces your risk. Second, professional management. You don't have to spend your nights and weekends researching which companies are poised for growth or which bonds are stable. A team of full-time analysts and managers is doing that work for you. You're essentially hiring a Wall Street pro for a very low cost. And third, accessibility. You can't buy one share of every company in the S&P 500 on your own without a massive amount of cash. But you can invest in an S&P 500 mutual fund with as little as 50 or 100 bucks. It gives everyday Americans access to the same powerful investment tools that were once reserved for the ultra-wealthy. Okay, so that's the what. A mutual fund is a giant pool of money used to buy a diversified basket of investments. Simple enough. But here's where the confusion on your 401k statement comes from. There are over 7,000 different mutual funds available in the United States. It's an ocean of options. But here's the secret. Almost all of them fall into one of four main categories. Think of it like the automotive world. There are thousands of car models, but they're all basically a sedan, an SUV, a truck, or a sports car. If you understand those four categories, you can walk onto any car lot and know exactly what you're looking at. Investing is the same. Once you master these four fund types, you've mastered the market. So what are they? The four main food groups of the investment world are stock funds, bond funds, money market funds, and target date funds. Let's put a pin in each one. First, you have stock funds, also known as equity funds. These are the engines of growth. When you buy a stock fund, that potluck basket is filled almost exclusively with stocks, tiny ownership pieces of public companies like Apple, Microsoft, or Tesla. Their goal is simple: capital appreciation. To grow your money as much as possible over the long term. They are the sports cars of the investment world. They have the potential for high speed and thrilling returns, but they also come with more volatility and risk. Second, you have bond funds, also known as fixed income funds. If stock funds are about growth, bond funds are about stability and income. When you buy a bond fund, the basket is filled with bonds, which are essentially loans you make to corporations or governments. In return for your loan, they promise to pay you regular interest payments. Bond funds are the reliable family sedans. They're not going to win you any drag races, but they are designed to be much safer, provide a steady stream of income, and protect your capital during bumpy rides in the stock market. Third, we have money market funds. These are the ultimate safety play. Think of this as the parking garage for your cash. The basket here is filled with extremely short-term, high-quality debt, like government T-bills. The goal of a money market fund isn't growth. It's capital preservation and liquidity. It aims to never lose a penny of your initial investment, while paying you a tiny bit of interest, often similar to a high-yield savings account. It's where you put money you can't afford to lose or might need to access tomorrow. And finally, our fourth category, target date funds, which are a type of hybrid or balanced fund. These are the all-in-one, set it and forget it solution. A target date fund is a fund of funds. Its basket is filled with a mix of other stock funds and bond funds. The magic is that this mix automatically changes over time. If you plan to retire around the year 2050, you'd buy a target date 2050 fund. When you're young and far from retirement, it will be aggressive, holding mostly stock funds for maximum growth. But as you get closer to 2050, it automatically and gradually shifts more of your money into safer bond funds to protect your nest egg. It's the self-driving car of investing, designed to get you to your destination with minimal input from you. Stock funds for growth, bond funds for stability, money market funds for safety, and target date funds for an all-in-one automated strategy. That's it. That is the entire framework. Every confusing fund name on your 401k statement is just a variation on one of these four themes. In the rest of this series, we are going to dive deep into each one, but just knowing this framework is half the battle. You now have a mental map to navigate the investment landscape. You're no longer lost in the woods. You have a compass and you know which way is north. So let's take our first step on this map. We're heading north, into the territory marked growth. This is the land of equity funds. When you hear the word investing, this is probably what you picture. Buying a piece of a company. An equity fund at its core is a giant basket filled with stocks. And a stock is simply a tiny slice of ownership in a public company. So when you put money into an equity fund like the Vanguard 500 Index Fund, you're not just buying some abstract financial product. You are instantly becoming a part owner of Apple, of Microsoft, of Amazon, of the 500 largest, most powerful companies in America. You own a sliver of every iPhone sold, a fraction of every package delivered. That's the magic of it. The primary goal here is simple: capital appreciation. That's the fancy term for growth. You buy your shares in the fund for, say, $100, and the hope is that over time the value of all those companies in the basket will increase, and your shares will be worth $150, $200, or even $1,000. Equity funds are the engine of your portfolio. They are the gas pedal. This is where you find the potential for the kind of explosive growth that can turn a modest savings account into a life-changing retirement nest egg over the long term. But equity fund is a huge category. It's like saying car. A Ferrari and a Ford F-150 are both cars, but you wouldn't use them for the same job. We need to get more specific. So let's pop the hood. First, we can categorize equity funds by company size, or what Wall Street calls market capitalization. You have your large cap funds. Think of these as the skyscrapers of the corporate world. These are the giants, the household names: Coca-Cola, Johnson & Johnson, Google. They are established, stable, and dominate their industries. Funds that focus on large cap stocks are generally considered less risky, because these companies are less likely to go out of business overnight. They are the bedrock of many long-term portfolios. Then you have mid-cap funds. These aren't the global giants yet, but they're not small startups either. They are the rising stars. Think of a successful regional company that's just starting to expand nationwide. They have a proven business model but still have significant room to grow. Investing here can be a sweet spot, offering a blend of the stability of larger companies with the higher growth potential of smaller ones. And finally, you have small-cap funds. These funds invest in the new kids on the block, the nimble, innovative, and sometimes disruptive companies that are trying to become the next Amazon or Tesla. This is where you find the highest potential for explosive growth. A small company can double or triple in size far more easily than a behemoth like Apple can. But with great potential comes great risk. These companies are more volatile and more likely to fail. It's the high-risk, high-reward part of the market. But size is only one dimension. We also have to talk about investing style. This is a huge one, and it boils down to a classic battle: growth versus value. Growth funds are exactly what they sound like. They invest in companies that are expected to grow faster than the overall market. These are often tech companies, biotech firms, or any business in a rapidly expanding industry. The managers of these funds are looking for the star quarterback, the company that's already scoring touchdowns and has a clear path to the Super Bowl. These stocks often look expensive based on their current earnings, but investors are betting that their future earnings will be so massive that today's price will look like a bargain in hindsight. Think of buying Tesla stock years ago. On the other side of the field, you have value funds. Value investors are like bargain hunters. They are meticulously searching for hidden gems. They look for solid, steady companies that the market has unfairly beaten down, or is simply ignoring. Maybe the company had a bad quarter, or it's in an unpopular industry. The value fund manager believes the company's true worth, its fundamentals, its assets, its reliable cash flow, is far greater than its current stock price. They're buying a $20 bill for $10 and are willing to wait for the rest of the market to realize its mistake. This is the strategy made famous by the legendary Warren Buffett. So now that we have our compass, let's turn it from north to west. If equity funds are the land of growth and volatility, our next destination is the land of stability and income. We are talking about bond funds, also known as fixed income funds. If equity funds are the gas pedal, bond funds are the brakes and the shock absorbers. They are designed to smooth out the ride. What is a bond? It's much simpler than it sounds. A bond is just a loan. That's it. When you buy a bond, you are lending money to an entity, which could be a corporation or a government. In return for your loan, they promise to pay you back the full amount, called the principal, on a specific date in the future, known as the maturity date. Along the way, they also pay you regular interest payments like a steady paycheck. A bond fund, then, is simply a giant collection of these loans. It might hold thousands of different bonds from hundreds of different issuers. The main goal here isn't explosive growth. It's capital preservation and income generation. You invest in a bond fund because you want to protect the money you have and earn a predictable stream of cash from it. It's the part of your portfolio that helps you sleep at night when the stock market is going haywire. Just like with equity funds, bond fund is a broad term. Let's break it down. First, we can look at who is borrowing the money. The biggest distinction is between government bond funds and corporate bond funds. Government bond funds are considered the safest of the safe. These funds lend money to the U.S. government by buying treasury bonds, or treasuries. These are backed by the full faith and credit of the United States, meaning the U.S. government guarantees it will pay you back. The odds of the U.S. government defaulting on its debt are about as close to zero as you can get in the world of finance. There are also municipal bond funds, which lend money to state and local governments to build things like schools, bridges, and highways. A huge perk here is that the income from these muni bonds is often exempt from federal, and sometimes state and local taxes. Then you have corporate bond funds. These funds lend money to companies, from blue-chip giants to smaller businesses. Why would a company issue bonds instead of just going to a bank? To raise money for expansion, research, or new projects. Because there's a higher risk that a company could go out of business compared to the US government, corporate bonds have to offer a higher interest rate to attract lenders like you. More risk, more reward. This brings us to our next way of slicing the pie: credit quality. Not all borrowers are created equal. You have investment-grade bond funds. These funds stick to bonds from the most financially stable governments and corporations. Think of it like lending money to a friend with an 800 credit score and a secure job. The risk of them not paying you back is very low, so you don't need to charge them a very high interest rate. Then you have the wilder side: high-yield bond funds, more famously known by their nickname, junk bonds. These funds lend to companies with weaker financial health or lower credit ratings. It's like lending money to a cousin with a crazy business idea. The risk of default is much higher, so to compensate for that risk, they have to offer you a much higher interest rate. These can provide a big income boost to a portfolio, but you have to be ready for the higher volatility. Finally, just like with a loan, the time frame matters. This is called maturity. Bond funds are often categorized as short-term, intermediate-term, or long-term. Short-term bond funds hold bonds that mature in just a few years. They are the least volatile and are most sensitive to changes in short-term interest rates set by the Federal Reserve. Long-term bond funds hold bonds that might not mature for 20 or 30 years. They typically offer higher interest rates to compensate you for tying up your money for so long. However, their prices are much more sensitive to changes in interest rates. If rates go up, the value of existing lower-rate long-term bonds goes down. Intermediate-term funds, as you can guess, are the happy medium, offering a balance of risk and return. So you have the engine for growth, equity funds, and the brakes for stability, bond funds. One is about growing your wealth, the other is about preserving it. For decades, the classic portfolio has been a strategic mix of both, letting them work together to balance each other out through the market's ups and downs. But what if you don't want to manually choose between the gas pedal and the brakes? What if you want a vehicle that can manage both for you, automatically adjusting as you get closer to your destination? That's where our third major category of mutual funds comes in. And for anyone who wants a set-it-and-forget-it approach to investing, it is an absolute game changer. This revolutionary approach is built around what are called hybrid funds, sometimes known as asset allocation funds. And the concept is beautifully simple. Instead of you having to buy a stock fund and a bond fund, a hybrid fund does the mixing for you. It holds both stocks and bonds, and sometimes even other assets, all within a single convenient package. It's like ordering a combo meal instead of buying the burger, fries, and drinks separately. You get a balanced meal, or in this case, a balanced portfolio with one single decision. Now, there are different types of hybrid funds, but the undisputed superstar, the one that has completely transformed retirement saving for millions of Americans, is the target date fund. You have almost certainly seen these in your 401k or IRA options. They have names like Freedom 2050 Fund or Retirement 2060 Portfolio. That date in the name is the magic key. It's the approximate year you plan to retire. So, if you're planning to retire around the year 2050, you'd pick the 2050 fund. Simple, right? But here's where the genius comes in. The fund manager knows that a young investor, decades away from retirement, can afford to take on more risk for a chance at higher growth. So, in its early years, a 2050 fund might be 90% stocks and only 10% bonds. It's in full-on growth mode, but you don't stay young forever. As you get closer and closer to that 2050 target date, the fund automatically, gradually, and systematically sells off some of its stocks and buys more bonds. The mix might shift to 80-20, then 70-30. By the time you're a few years from retirement, it might be a much more conservative 50-50 split, or even more heavily weighted towards bonds. This automatic shift is called the glide path. Think of it like an airplane pilot landing a plane. When the plane is far from its destination, it's flying high and fast, covering a lot of ground. That's your portfolio when you're young, aggressive, and full of stocks. As the plane nears the airport, the pilot doesn't just cut the engines and drop from the sky. That would be a disaster. Instead, they begin a slow, controlled descent, reducing speed and altitude gradually. That's your target date fund's glide path, gradually reducing risk by shifting from stocks to bonds. The goal is a smooth, safe landing into retirement, not a turbulent crash right before you need your money. This automation is the single biggest selling point. It solves two of the biggest problems investors face: First, rebalancing. Most experts recommend you rebalance your portfolio, meaning sell some of your winners and buy more of your losers to get back to your desired risk level, at least once a year. But let's be honest, most people forget, or they don't know how, or they're just too busy. A target date fund does this for you constantly. Second, and maybe more importantly, it takes your emotions out of the driver's seat. When the stock market is soaring, it's tempting to go all in on stocks. When it's crashing, the instinct is to panic and sell everything. A target date fund ignores that noise. It has a pre-programmed mission, and it sticks to the flight plan, protecting you from your own worst instincts. For the vast majority of people who just want to contribute to their 401k and not think about it again, this is an incredible invention. But, and this is a big but, set it and forget it does not mean set it and be ignorant. You still need to understand what you own, and target date funds have a few crucial details you absolutely need to know. First, not all glide paths are created equal. One company's 2050 fund might be more aggressive than another's. They might have different definitions of risk. This is why you can't just compare them by name alone. You need to look under the hood. And here's a really important distinction. Is the fund a to-retirement fund or a through-retirement fund? A to fund is designed to be at its most conservative on your retirement date. The glide path effectively ends there, assuming you'll move your money into something else. A through fund, on the other hand, is designed to last throughout your retirement. It assumes you'll be drawing money from it for the next 20 or 30 years. So its glide path continues, and it will maintain a healthy allocation to stocks well into retirement to keep your money growing and fight inflation. Understanding which type you have is critical for managing your money once you actually stop working. The other thing to watch out for is cost. Many target date funds are what's known as a fund of funds. This means the target date fund itself doesn't directly own stocks and bonds. Instead, it owns a collection of other mutual funds. For example, your 2050 fund might hold shares of a U.S. stock index fund, an international stock index fund, and a total bond market index fund, all from the same company. This is great for diversification, but it can sometimes mean you're paying two layers of fees: the fee for the target date fund itself, plus the underlying fees of the funds it holds. Now the competition has gotten fierce, and many target date funds, especially those from low-cost providers like Vanguard or Fidelity, have very reasonable expense ratios. But you still have to check. A seemingly small difference in fees, say 0.5%, can cost you tens or even hundreds of thousands of dollars over a 40-year investing career. Finally, remember that a target date fund is a one-size-fits-all solution. It assumes you are an average investor with an average risk tolerance. But you might not be average. Maybe you have a pension and Social Security, so you can afford to be much more aggressive with your 401k. Or maybe you're a very nervous investor, and even the conservative allocation of your target date fund feels too risky for you. The fund doesn't know you. It's a fantastic starting point, but it's not a personalized financial plan. Now, target date funds are the most popular type of hybrid, but they aren't the only ones. You also have what are often called balanced funds or static allocation funds. Unlike a target date fund, these funds don't have a glide path. They maintain a fixed or static mix of stocks and bonds over time. The classic example is a 60-40 balanced fund. This fund will always aim to have about 60% of its assets in stocks and 40% in bonds. The manager will rebalance to maintain that specific mix, but it won't get more conservative as you get older. You have to make that decision yourself. These are good for investors who know what level of risk they're comfortable with and want to stick with it, without having to manage two separate funds. They offer a simple one-fund solution for a specific risk profile, whether it's conservative, moderate, or aggressive. So, who are hybrid funds for? Honestly, for almost everyone starting out. If you are opening your first 401k, and the list of 30 different fund options looks like a foreign language, picking the target date fund closest to your retirement year is almost always a fantastic choice. It gets you invested, diversified, and on a professionally managed plan from day one. They are for the hands-off investor, the busy professional, or anyone who wants to harness the power of the market without becoming a financial analyst. They provide a clear, simple, and powerful path toward a financial goal. We've covered funds for growth with stocks, funds for stability with bonds, and funds that cleverly combine the two. We've built a portfolio for the long haul. But what if your goal isn't decades away? What if you need a safe, stable place to park your cash for the short term? Maybe for a down payment on a house next year? Or for your emergency fund? You want it to be safe, but you'd still like it to earn a little more than the pitiful interest from a standard savings account. That's where our fourth and final major category of mutual funds comes in, and it's one that many people use every single day without even realizing what it is. This is the money market fund. And if you have a brokerage account with any of the big names, Fidelity, Schwab, Vanguard, chances are the cash just sitting in your account isn't actually cash. It's sitting in a money market fund, a special vehicle designed to be the financial equivalent of a high-security parking garage for your money. So what exactly is it? A money market mutual fund is an investment whose primary goals are, in this order: 1. To not lose your money, and 2. To earn a tiny bit of interest. That's it. It's not designed for growth. It's designed for stability and liquidity, meaning you can get your money out at a moment's notice. To achieve this, these funds invest in only the safest, most short-term debt imaginable. We're talking about things like U.S. Treasury bills, which are IOUs from the U.S. government that get paid back in a year or less. They also buy something called commercial paper, which is essentially a short-term loan to a massive, financially sound corporation, or certificates of deposit from major banks. The entire system is built around one single sacred number: $1. The goal of every money market fund is to keep its share price, or net asset value, pegged at exactly $1. You put $1 in, you own one share. You take $1 out, you redeem one share. The interest you earn is paid out as additional shares. It's designed to feel exactly like a cash account, but it's not. And that single crucial difference led to one of the most terrifying moments in modern financial history. To understand it, we have to go back to the fall of 2008. The world was on fire. The subprime mortgage crisis had spiraled out of control, and giants of Wall Street were beginning to topple. On Monday, September 15, 2008, the unthinkable happened. Lehman Brothers, a 158-year-old investment bank, a titan of the financial world, declared bankruptcy. The shockwave was instantaneous, but the real panic didn't start with the stock market. It started in the one place everyone thought was safe: a money market fund called the Reserve Primary Fund. This wasn't some fly-by-night operation. It was the oldest money market fund in America. For decades, it was the gold standard for safety. Millions of people, from regular savers to giant corporations, parked their cash there, believing it was as safe as a bank. But it held a secret vulnerability. To get a slightly better yield for its investors, the Reserve Primary Fund owned about $785 million worth of commercial paper from Lehman Brothers. When Lehman went bankrupt, that paper, that promise to pay, became essentially worthless overnight. The next day, on Tuesday, September 16th, the fund's managers did the math and faced a horrifying reality. The losses were so great that they could no longer maintain their $1 per share value. They announced that their NAV had fallen to 97 cents. They had broken the buck. 3 cents. Sounds like nothing, but it was a nuclear bomb detonated in the heart of the financial system. The core promise of the entire $3.5 trillion money market industry, that a dollar is always a dollar, had been broken. And if the oldest, most respected fund could break, then none of them were safe. What followed was a silent electronic bank run. But instead of people lining up on the street, it was corporations, pension funds, and individual investors yanking their money out as fast as they could. In a single week, investors pulled over $300 billion out of prime money market funds. This wasn't just a problem for the funds, it was a problem for everyone. The entire system of short-term lending that companies used to make payroll and buy inventory was freezing solid. The credit that is the lifeblood of the economy stopped pumping. This was the moment the 2008 crisis went from a Wall Street problem to a Main Street catastrophe. The situation was so dire that the U.S. Treasury had to step in with an unprecedented emergency action, temporarily guaranteeing all money market fund deposits up to that sacred $1 mark, just like the FDIC does for banks. It was a government backstop that narrowly prevented a full-scale collapse of the global economy. That story is the single most important lesson about money market funds. They are incredibly safe, but they are not risk-free. They are not FDIC insured. In the wake of the crisis, the SEC enacted new rules to make them even safer, including stricter requirements on the quality and maturity of their holdings. They even created mechanisms like liquidity gates and redemption fees, which a fund could, in an extreme crisis, use to slow down a panicked run and prevent a fire sale of its assets. So now that we've journeyed through the chaos, let's bring it all together. We've explored the 4 fundamental types of mutual funds. Think of them as the 4 primary tools in your financial toolkit. First, you have stock funds. These are your power tools, your drills and your saws. They have the most potential to do the heavy lifting of building serious long-term wealth. They come with higher risk and volatility, but over time they offer the greatest power for growth. Second, you have bond funds. These are your precision instruments, your level, your square, and your measuring tape. Their job isn't rapid construction. It's about stability, preservation, and creating a steady, predictable foundation. They generate income and reduce the overall choppiness of your portfolio. Third, you have balanced funds or hybrid funds. This is your all-in-one multi-tool. It has a screwdriver, a knife, and a pair of pliers all in one convenient package. It's a fantastic, simple starting point that gives you a bit of everything, some growth from stocks, some stability from bonds. It might not be the absolute best specialized tool for every single job, but its versatility and ease of use are unmatched. And finally, you have money market funds. This isn't a tool for building at all. This is the workbench itself. It's the safe, sturdy, and stable place you put your cash, your raw materials, when you're not actively using it to build. It's not meant to create anything on its own, but to protect what you have until you're ready to deploy it. Stock funds for growth, bond funds for stability, balanced funds for simplicity, and money market funds for safety. Understanding these 4 categories is the first giant leap toward taking control of your financial future. You now know what the tools are and what they're designed to do. But just knowing what a power drill is doesn't mean you know how to build a house. In fact, picking the wrong fund, even within the right category, can be disastrous. There are hidden costs, secret drags on performance that can silently siphon away tens, or even hundreds of thousands of dollars from your returns over your lifetime. And it all comes down to a single number, one tiny percentage that most investors completely ignore. We're about to pull back the curtain on that number, because understanding it is the real key to separating a good investment from a terrible one. That number is called the expense ratio, and it is, without a doubt, the single most reliable predictor of your future investment success. It sounds boring, I know. Expense ratio. It sounds like something you'd find on a spreadsheet in a dusty accounting office. But I promise you, this little percentage is the silent killer of wealth, the tiny leak that sinks a giant ship. And by the end of this, you'll see it not as a boring number, but as the secret code to unlocking your financial future. To really understand its power, let's tell a story. A tale of 2 investors. We'll call them Sarah and Tom. They're both 30 years old, they both have the same job, the same salary, and they both decide to start investing for retirement on the exact same day. They each have $10,000 to start, and they both plan to contribute $500 every single month for the next 30 years. They are, for all intents and purposes, identical, except for one tiny decision. Sarah, after doing some research, decides to invest in a low-cost S&P 500 index fund. This is a type of stock mutual fund that simply aims to mirror the performance of the 500 largest companies in the US. It's simple, it's diversified, and most importantly, its expense ratio is a minuscule 0.04%. Tom, on the other hand, gets a tip from a coworker about a hot new fund. It's an actively managed large-cap stock fund. It has a star fund manager with a great track record, a slick marketing brochure, and a team of brilliant analysts. It invests in many of the same companies as Sarah's fund, but it tries to be clever, buying and selling to beat the market. All of this expertise comes at a price. Its expense ratio is 1.25%. Now you might be thinking, what's the big deal? 1.25%. It's basically nothing. The difference between 0.04% and 1.25% is just over a single percentage point. In a world of 20% stock market gains and 7% inflation, who cares about 1%? That, right there, is the multi-trillion-dollar mistake that millions of investors make every single year. They dismiss the small number, but they forget about the 2 most powerful forces in the universe: time and compound interest. Let's fast forward 30 years. Sarah and Tom are now 60, ready to retire. Let's assume that over those 3 decades, the overall stock market returned an average of 8% per year. First, let's look at Sarah. Her fund earned 8% per year, but she had to pay that tiny 0.04% fee. So her net return was 7.96% per year. After 30 years of investing her initial $10,000 and adding $500 a month, Sarah's retirement account is worth approximately $791,000. Not bad at all. She's looking at a very comfortable retirement. Now let's look at Tom. His fund also invested in the same market, which earned 8% per year. But his star manager and team of analysts cost him 1.25% every single year, whether the fund did well or poorly. So his net return was only 6.75% per year. After 30 years of investing the exact same amount of money on the exact same schedule as Sarah, Tom opens his retirement statement. His final balance is approximately $608,000. Let that sink in. $183,000. That is the difference. Tom has over $180,000 less than Sarah, simply because of a 1.21% difference in fees. He worked just as hard. He saved just as diligently. But a massive chunk of his nest egg, enough to fund years of retirement, vanished into thin air. It was eaten year after year by that seemingly insignificant fee. Where did that money go? It went to pay for the fund manager's bonus. It went to pay for the fancy office building in Manhattan. It went to pay for the glossy marketing materials that convinced Tom to invest in the first place. Tom paid for a first-class ticket, but ended up in the same destination as Sarah, who flew coach, only he arrived with significantly less luggage. This is the devastating power of the expense ratio. It's not just the fee you pay in a given year. It's the ghost of all the future growth that money could have generated. The $125 Tom paid in fees on his first $10,000 wasn't just $125. It was the $2,700 that money would have become over 30 years if it had been left in his account to compound. Every dollar paid in fees is a dollar that can no longer work for you. It's a soldier removed from your financial army forever. So what exactly is the expense ratio paying for? It's the cost of keeping the lights on at the mutual fund company. Covers three main things. First, the management fee. In an actively managed fund like Tom's, this is the biggest piece. It pays the salaries and bonuses of the portfolio managers and their team of research analysts who are supposedly picking the winning stocks. In a passive index fund like Sarah's, this fee is microscopic because there's no star manager to pay. A computer algorithm is simply making sure the fund holds the right stocks to match the index. Second, administrative costs. This is the boring stuff. Record keeping, customer service, mailing statements, legal and accounting expenses. Every fund has these, but scale matters. A massive fund with $1 trillion in assets can spread these costs out, so they become almost zero for each individual investor. Third, and this is a sneaky one, are the 12b-1 fees. Named after an SEC rule, these are fees that are technically for marketing and distribution. Yes, you are paying the fund company to advertise itself so it can attract more investors. It's like paying a restaurant for the commercials that convinced you to eat there. Low-cost index funds almost never have these. High-cost active funds often do. Now, how does this apply to our four main types of funds? For stock funds, this is ground zero. The battle between high-cost active funds and low-cost index funds is the clearest example of the expense ratio's impact. Study after study has shown that over long periods, the vast majority of active fund managers, something like 80 to 90% of them, fail to beat simple low-cost index funds. They charge you more for the promise of beating the market, and then they fail to do it. For bond funds, the same rule applies, but it's even more critical. Because bonds historically have lower returns than stocks, fees take an even bigger bite out of your potential profit. A 1% fee on a bond fund that's only expected to return 4% is catastrophic. That's a full quarter of your earnings gone. For target date funds, you have to be extra careful. Many of these are what's called a fund of funds, meaning they are a mutual fund that just holds other mutual funds. Sometimes you can get hit with two layers of fees: the expense ratio for the target date fund itself, and the expense ratios of all the underlying funds it holds. You have to look for target date funds built from low-cost index funds to avoid this wealth-destroying double dip. And for money market funds, while the fees are usually very low, they still matter. These funds are for safety and cash-like returns, so every 100th of a percentage point counts. The bottom line is this: the expense ratio is the one cost you can 100% control. You can't control whether the stock market goes up or down. You can't control what the Federal Reserve does with interest rates. But you can absolutely control how much of your hard-earned money you give away to Wall Street every single year. Financial companies spend billions on marketing to distract you from this simple fact. They want you to focus on past performance, which is no guarantee of future results. They want you to be starstruck by a famous manager. They want you to believe their proprietary strategy is worth the high price tag. The expense ratio is usually buried deep inside a 100-page legal document called a prospectus, hoping you'll never look. But now you know the secret. You know that this one number is the key. And unfortunately, the expense ratio isn't the only fee they try to hide from you. There are other, more blatant costs that can ambush you the moment you decide to invest or the moment you decide to sell. They have innocent-sounding names like loads, but they are nothing more than sales commissions designed to take money right out of your pocket before it ever has a chance to grow. And these loads are the next trap we need to expose. Let's start with the most straightforward one: the front-end load. Think of it as a cover charge to get into a club. Before your money even gets a chance to dance on the market floor, a bouncer takes a cut right at the door. These funds are often called A-shares. The sales charge or load is paid up front when you buy the fund. A typical front-end load can be as high as 5.75%. Let's put that into perspective. Imagine you've saved up $10,000. You're excited. You're ready to invest for your future. You hand it over to invest in a fund with a 5.75% front-end load. Instantly, $575 vanishes. Poof! It doesn't go into your investment. It goes directly into the pocket of the brokerage firm and the financial advisor who sold you the fund. Your actual investment, the amount that starts working for you, is only $9,425. You are immediately in the hole. Your investment has to grow by over 6% just for you to get back to even. It's like starting a 100-meter dash 20 feet behind the starting line. Why do these exist? Simple. To compensate the person selling it to you. It's a sales commission, plain and simple. Proponents will argue that A-share funds might have slightly lower annual expenses down the road, but that initial haircut is so severe, it's a massive, often insurmountable disadvantage from day one. Now, the industry got clever. They realized some investors were smartening up to these upfront fees. So, they created a different kind of trap, one that looks more appealing at first glance. This is the back-end load, also known as a contingent deferred sales charge, or CDSC. These funds are often called B-shares. With a back-end load, you don't pay anything up front. Your full $10,000 goes to work for you immediately. Sounds great, right? But there's a catch, a big one. The load is charged when you sell your shares, and the fee is contingent on how long you've held them. It's like a financial penalty box. If you try to leave early, you pay a steep price. Typically, a back-end load is on a declining schedule. For example, if you sell within the first year, you might pay a 5 or 6% fee. Sell in year 2 and it drops to 4%. Year 3 it's 3%, and so on until after 6 or 7 years the fee disappears entirely. The brokerage is essentially putting you in financial handcuffs. They're betting that you'll stay put, either through inertia or because you don't want to pay the penalty. And while you're locked in, they get you another way. B-shares almost always carry higher annual expense ratios than their A-share counterparts. They bake in extra fees, particularly something called a 12B1 fee, which is a marketing and distribution fee that goes right back to the broker as a commission year after year. So you're trapped in a fund that might be underperforming, and you're paying a higher annual cost for the privilege of being trapped. It's a lose-lose. The good news is that B-shares have become so notorious that they are largely being phased out, but millions of investors are still holding them, often without realizing the trap they're in. This brings us to the third and perhaps most insidious type of load, the level load or C-shares. These are the masters of disguise. C-shares typically have no front-end load. They might have a small back-end load, maybe 1%, but only if you sell within the first year. After that, it's gone. So what's the problem? Seems like the best of both worlds. The trap with C-shares is a slow, relentless bleed. They charge a high, ongoing annual fee year after year, for as long as you own the fund. This fee, usually around 1%, is another form of that 12B1 fee we just talked about. It's a permanent commission paid to your advisor. It never goes away. A 1% fee might not sound like much, but let's do the math. On a $100,000 investment, that's $1,000 every single year. Over 10 years, that's $10,000 in fees, not even counting the lost growth on that money. Over 20 years, it's $20,000. Compare that to the one-time hit of an A-share. For a long-term investor, a C-share can end up being the most expensive option of all. It's a leaky bucket. You keep pouring your savings in, but a portion is constantly draining out the bottom, year after year, eroding your returns without you ever seeing a bill. So you have the upfront toll booth of A-shares, the exit penalty of B-shares, and the slow poison of C-shares. It all sounds pretty bleak. It sounds like no matter what you do, someone is standing there with their hand out, ready to take a piece of your hard-earned money. But what if I told you there was a fourth door? A door with no cover charge, no exit penalty, and no hidden permanent commission. This is the world of no-load funds. A no-load fund is exactly what it sounds like. It has no sales charge. None. You invest $10,000, and the full $10,000 goes to work for you on day one. You decide to sell 10 years later? You don't pay an exit fee. The entire value of your investment is yours to keep. This sounds too good to be true, right? There must be a catch. But there isn't. The reason no-load funds exist is because some fund companies decided to sell their products directly to investors, cutting out the middleman, the commission broker. Companies like Vanguard, Fidelity, and Charles Schwab built their empires on this model. They understood that if you offer a great product at a fair price, without the baggage of sales commissions, savvy investors will come. So why on earth does anyone buy a load fund? Because load funds are sold, not bought. They are pushed by financial advisors and brokers who work on commission. When their paycheck depends on selling you a product with a built-in commission, that's the product they're going to recommend, whether it's in your best interest or not. They might justify it by saying they provide valuable advice, but you should always know that you are paying for that advice through these hefty, often hidden fees. By choosing to invest in no-load funds, you are taking control. You are bypassing the expensive toll roads and choosing the freeway. You can go directly to a low-cost brokerage house, open an account, and buy these funds yourself, ensuring that 100% of your money is working for you from the very beginning. Avoiding loads is the single biggest, easiest step you can take to improve your investment returns. It's a one-time decision that pays dividends for the rest of your investing life. You have now seen the trap, you understand how it works, and you know the escape route. But clearing this hurdle is only the first step. You've successfully avoided the obvious pickpocket, the one who tries to take your money at the front gate. But there's another, more subtle drain on your wealth. A silent fee that works against you every single day, every single year, whether the market is up or down. It's a number hidden deep in a fund's prospectus, and it has a far greater impact on your long-term wealth than any load ever could. It's called the expense ratio, and it's the silent killer of investment returns. The expense ratio is an annual fee, expressed as a percentage, that a mutual fund charges to cover its operating costs. Think of it like a landlord charging for building maintenance. The fund has to pay its managers, its research analysts, its accountants, and cover the costs of marketing and administration. And where does that money come from? Comes directly out of your investment. It's automatically deducted from the fund's assets, which means it's deducted from your returns every single day, without you ever seeing a bill. Imagine you and your friend are driving identical cars on a cross-country road trip from New York to Los Angeles. Your car is in perfect shape. Your friend's car, however, has a tiny, almost imperceptible fuel leak. Just one drop of gasoline every few miles. For the first 100 miles driving through New Jersey, you wouldn't even notice a difference. By the time you reach Ohio, your friend might be $1 or $2 behind at the pump. Annoying, but not a big deal. But by the time you cross the Rocky Mountains, that tiny leak has become a serious problem. Your friend has had to stop for gas more often, spending significantly more money. And by the time you both pull into Santa Monica, you're celebrating on the pier while your friend is staring at a credit card statement filled with hundreds of dollars in extra fuel charges. That tiny, insignificant leak, compounded over 3,000 miles, turned into a massive, undeniable expense. The expense ratio is that tiny leak in your financial engine. And your investing timeline isn't 3,000 miles. It's 30 or 40 years. Let's make this real. Meet two investors, Sarah and Tom. They're both 30 years old, and they each decide to invest a lump sum of $10,000 for their retirement. They don't touch it for 30 years. Let's assume both of their chosen funds manage to earn an average gross return of 8% per year. The only significant difference is the leak, the expense ratio. Sarah is cost-conscious. She does her research and invests in a broad market index fund. Let's say its expense ratio is a very low 0.04%. This is a real-world number for many popular index funds. Tom, on the other hand, is drawn in by a fancy, actively managed fund his bank recommended. It has a star manager and a great marketing brochure promising to beat the market. Its expense ratio is 1.25%. This might sound small. It's just over a 1% difference. But let's start the engines and see what happens on this road trip to retirement. After 1 year, with an 8% gross return, Sarah's $10,000 would grow to $10,796. Tom's would grow to $10,675, a difference of about $121. Tom might not even notice. It's a rounding error, right? The cost of a nice dinner. He's not worried. Let's fast forward 10 years. Compounding has been at work. Sarah's account, with its tiny 0.04% leak, has grown to $21,567. Tom's account, with its 1.25% leak, has grown to $19,134. The gap has widened to over $2,400. Now we're talking about a mortgage payment. Tom is starting to feel it. That leak is no longer just a few drops. It's a steady drip, siphoning away his growth year after year. But the real magic, or the real horror, happens over the long term. Let's jump ahead to year 30, when they're both 60 and thinking about retirement. Sarah opens her statement. Her initial $10,000 has grown to an incredible $100,451. That's the power of the market and the magic of compounding with minimal friction. Now it's Tom's turn. He opens his statement, expecting a similar result. After all, his fund earned the same 8% gross return. But his final balance is only $68,485. Let that sink in. Sarah has over $31,000 more than Tom. That's more than 3 times his initial investment, vanished into thin air. Where did it go? It was consumed by that tiny 1.21% difference in fees. That leak didn't just cost him the fees themselves, it cost him all the growth that money would have generated for decades. He didn't just lose a few thousand in fees, he lost a 5-figure mountain of potential wealth. He lost a new car. He lost years of travel in retirement. He lost financial peace of mind. All because of a number he probably never even bothered to look up. This isn't an exaggeration. This is the simple, brutal math of compounding fees. And it's why understanding the expense ratio is not optional. It is the single most important predictor of your future investment success. So what are you actually paying for with that percentage? The expense ratio is typically broken down into a few parts. The biggest chunk is the management fee. This pays the salary of the portfolio manager and their team of analysts who are picking the stocks or bonds. In an actively managed fund like Tom's, this fee is high because you're paying for their supposed expertise to outperform the market. In a passively managed index fund like Sarah's, this fee is minuscule because the fund isn't trying to be clever. It's simply trying to replicate an index like the S&P 500, a job largely done by computers. Then you have administrative costs. These are the boring but necessary expenses. Record keeping, customer service, legal fees, and accounting. But there's another, more controversial fee often bundled in, known as a 12b-1 fee. This fee is named after an SEC rule, and it allows a fund to charge its own shareholders for marketing and distribution costs. Let me repeat that. You are paying the fund out of your investment returns so that it can go out and buy television commercials and fancy brochures to attract new investors. It is one of a fund's sneakiest ways to pass its business costs directly onto you. Low-cost index funds almost never have 12b-1 fees. Higher-cost active funds often do. Now, the defenders of high expense ratios will make a simple argument: you get what you pay for. They claim that their brilliant, highly paid fund managers will generate returns so spectacular that they will more than make up for the higher fees. They promise to beat the market. It's a beautiful promise. It's also a promise that is, for the vast majority of funds, statistically untrue. Study after study, most famously the SPIVA report from S&P Dow Jones Indices, has shown the same result year after year, decade after decade. Over any long-term period, 10, 15, or 20 years, more than 85 to 95% of actively managed U.S. stock funds fail to beat their benchmark index. They fail to do the one job they charge you a premium to do. And remember, that's just their performance. When you factor in their higher fees, the picture gets even worse. They're not just failing to beat the market, they're charging you a fortune for the privilege of underperforming. It's like paying a premium for a sports car that consistently loses races to a reliable family sedan. So how do you find this number? How do you check the size of the leak in your own investments? It's easier than you think. Every mutual fund is required by law to publish its expense ratio. You can find it on the fund's official website, typically in a document called the summary prospectus. Or even easier, you can just type the fund's name or ticker symbol into a financial website like Yahoo Finance or Morningstar. The expense ratio will be listed right there in the main profile, clear as day. Finding it takes less than 30 seconds, but those 30 seconds could be the most profitable you ever spend, potentially saving you tens or even hundreds of thousands of dollars over your lifetime. The war for your retirement returns isn't won with brilliant stock picks or daring market timing. It's won by controlling the one thing you have absolute power over: costs, by minimizing that slow, silent, wealth-destroying leak. Now that we understand the devastating power of fees, It's time to look at the battlefield where this war for your returns is fought. We need to zoom in on the specific types of funds themselves. We'll start with the champion of low cost, the heavyweight contender that Warren Buffett himself has endorsed for the average person, the vehicle that completely changed the investing game forever, the index fund. Imagine trying to invest in the stock market in the 1960s. Your main option was to hire a slick, well-dressed fund manager in a Wall Street office. You'd hand over your hard-earned money, and he, along with his team of expensive analysts, would promise to use their superior intellect and secret insights to pick winning stocks and beat the market. You paid them a hefty fee for this expertise, a percentage of your money every single year, whether they won or lost. For decades, this was just how it was done. It was the only game in town. The problem was, study after study showed a dirty little secret. The vast majority of these brilliant, high-paid experts failed. They didn't beat the market. In fact, after you factored in their fees, most of them dramatically underperformed it. Then, a man named John Bogle came along and asked a question so simple, so profound it was considered heresy. He looked at all these managers failing to beat the market average and said, "Why even try? What if, instead of paying a fortune for someone to hunt for the needle in the haystack, we just buy the whole haystack?" This was the revolutionary idea behind the very first index fund, launched in 1976. The concept was straightforward. Instead of picking individual stocks, the fund would simply buy and hold every single stock in a major market index, like the S&P 500. Its goal wasn't to be a star player. Its goal was to be the entire team. It aimed to perfectly match the market's performance, not beat it. When Bogle launched his fund, the entire financial industry laughed at him. They called it Bogle's folly. They said it was un-American to settle for average. Who would want to guarantee themselves mediocrity? The initial launch was a colossal failure. They were hoping to raise $150 million. They barely scraped together $11 million. But Bogle was right and the entire industry was wrong. He understood a fundamental truth that Wall Street didn't want you to know. The single biggest factor in your long-term investment returns isn't brilliant stock picking. It's cost. So how does it work? An index fund is the ultimate passive investment. There's no manager making decisions. Think of the S&P 500. It's not a company. It's just a list of the 500 largest, most influential public companies in the United States. It's a barometer for the overall health of the American economy. An S&P 500 index fund is programmed to do one thing and one thing only: own those 500 companies in the exact same proportions as the index itself. If Microsoft makes up 7% of the index's total value, the fund puts 7% of its money into Microsoft stock. If a company gets kicked out of the S&P 500 and a new one is added, the fund automatically sells the old one and buys the new one. No emotion, no guesswork, no expensive research trips to Omaha. It's a simple, rules-based, computer-driven strategy. And because it's so simple, it is incredibly, unbelievably cheap. This is the superpower of the index fund. That slick fund manager from the 1960s, the one trying to beat the market? His fund might charge you an expense ratio, the annual fee of 1% or more. That sounds small, right? Just 1%. But an S&P 500 index fund from a low-cost provider like Vanguard, Fidelity, or Schwab might have an expense ratio of 0.03%. Let's put that into real dollars. If you have $100,000 invested, that 1% fee costs you $1,000 every single year. The 0.03% fee costs you just $30. Now let's see what that difference does over time. Imagine two investors, both starting with $100,000, and both earning the same 8% average annual return before fees. Investor A is in the expensive, actively managed fund paying 1%. Investor B is in the low-cost index fund paying 0.03%. After 30 years, Investor B, the index fund investor, has over $1 million. How about Investor A? His high fees have eaten away at his returns year after year. That 1% fee didn't just cost him $1,000 a year. It cost him all the growth that money would have generated. He ends up with just over $760,000. The difference is nearly $250,000. It's the same starting money, the same market performance. The only difference is the cost. The index fund's low cost is like a powerful tailwind, constantly pushing your returns higher, while the high fees of an active fund are like a parachute, constantly dragging you down. The second superpower is instant diversification. When you buy a single share of a total stock market index fund, you instantly become a part owner of thousands of U.S. companies. You own a piece of Apple, a sliver of Walmart, a fraction of a local bank in Ohio, and a startup in Silicon Valley. You're not betting on one horse to win the race. You are betting on the entire American economy to continue to innovate, grow, and create value over the long term. If one company goes bankrupt, it's a tiny blip in your portfolio, cushioned by the success of thousands of others. This is the opposite of putting all your eggs in one basket. This is buying a fractional interest in every egg factory in the country. This is precisely why Warren Buffett, the man who became a billionaire by masterfully picking individual companies, has repeatedly stated that the best investment for the vast majority of Americans is a low-cost S&P 500 index fund. He even put his money where his mouth is. In 2007, he made $1 million bet against the hedge fund industry. He wagered that over the next 10 years, a simple unmanaged S&P 500 index fund would outperform a portfolio of 5 hand-picked hedge funds, managed by the so-called smartest guys in the room. The result? It wasn't even close. The index fund absolutely crushed the high-fee hedge funds. Buffett's point was devastatingly clear. The massive fees charged by active managers create a hurdle that is nearly impossible to overcome, even for the most brilliant financial minds. And the world of index funds is vast. It's not just the S&P 500. You can buy a total stock market index fund to own a piece of almost every public company in the US, big and small. You can buy an international stock index fund to diversify across the entire globe. You can buy a bond index fund to own a basket of thousands of different government and corporate bonds. You can build an entire, globally diversified, ultra-low-cost portfolio for your retirement using just 2 or 3 of these simple funds. So what's the catch? There has to be a catch, right? The catch, if you can call it that, is that an index fund by its very design will never beat the market. You are guaranteed to get the market's average return, minus a tiny fee. You're signing up for a solid B+ performance forever. You give up the lottery ticket dream of finding the next Amazon in your garage and turning $1,000 into $1 million. But in exchange, you also eliminate the very real risk of picking the next Enron and watching your investment go to zero. It is a disciplined, patient, and for many, a boring path to building wealth. It's the financial equivalent of a crock pot, not a microwave. It's the slow, steady, and overwhelmingly proven way to win the long game. This philosophy of passive investing, of simply owning the market at the lowest possible cost, has completely reshaped the financial world. But it's not the only way. What if you don't want to settle for average? What if you believe there are still brilliant managers out there who can justify their fees, who can navigate the treacherous waters of the market and deliver superior returns? For that, you need to look at the ideological opposite of the index fund. You need to explore the world of the actively managed fund. And if an index fund is like a commercial airliner, flying a predetermined route from New York to LA on autopilot, an actively managed fund is a fighter jet. At the controls is a Top Gun pilot, the fund manager, who has one mission and one mission only: to get you to your destination faster and safer than everyone else, even if it means pulling high-G maneuvers, finding unconventional shortcuts, and engaging in dogfights along the way. This is the world of human ingenuity versus the algorithm, of conviction versus automation. An actively managed fund is built on a simple, powerful, and incredibly seductive idea: that a smart, dedicated professional or a team of them can use their expertise, research, and intuition to pick winning investments and avoid losing ones, ultimately delivering returns that are better than the overall market average. They aren't trying to be the market, they are trying to beat the market. This is the promise of alpha. Alpha is the holy grail of investing. It's the measure of a manager's skill, the extra return they generate above and beyond what the market itself provided. If the S&P 500 goes up 10%, and your actively managed fund goes up 13%, that 3% difference, that's your manager's alpha. That is the genius you are paying for. And make no mistake, you do pay for it. The expense ratios for these funds are significantly higher than for their passive index cousins. While an S&P 500 index fund might charge you a minuscule 0.03%, an actively managed fund might charge 0.8%, 1%, or even more. That difference might sound small, but it is a massive hurdle. It means your Top Gun fund manager doesn't just have to fly better than the commercial airliner, they have to fly so much better that it covers the massive cost of their jet fuel, their advanced systems, and their own hefty salary, and still get you there ahead of schedule. So how do they try to do it? Through relentless obsessive work. They aren't just buying the 500 biggest companies. They are poring over financial statements, building complex valuation models, and interviewing CEOs and factory floor managers. They're flying to a different country to kick the tires on a potential investment. They're analyzing macroeconomic trends, predicting interest rate moves, and trying to get inside the minds of consumers. They are making thousands of conscious decisions: buy more Apple, sell all our shares in that regional bank, avoid the entire energy sector for the next 6 months, take a chance on this small, unknown biotech company that we think is on the verge of a breakthrough. The legend of active management is built on the shoulders of giants, managers who became superstars, an investor's version of a rock god. And there is no greater legend than Peter Lynch. From 1977 to 1990, Lynch ran the Fidelity Magellan Fund, and what he accomplished is the stuff of Wall Street myth. He took a small, obscure fund and turned it into the largest in the world, delivering an average annual return of 29.2%. For 13 years. If you had invested $10,000 with him in 1977, you would have had over $280,000 by the time he retired in 1990. During that same period, the S&P 500, the benchmark he was trying to beat, only returned about half that. He didn't just beat the market. He absolutely crushed it year after year. His philosophy was famously simple: invest in what you know. He wasn't just looking at charts, he was observing the world. He invested in Hanes because his wife told him how much she liked their legs pantyhose. He invested in Taco Bell because he was impressed with their food on a trip to California. He saw the potential in companies that everyday people interacted with. He was the ultimate proof of concept for active management. A brilliant mind who could see value where others didn't and translate that vision into life-changing wealth for his investors. This is the dream that every active fund sells you. The chance to find the next Peter Lynch. The chance to have a brilliant pilot navigating your money through the turbulence. And here's where we have to have a very honest, very difficult conversation. Peter Lynch was the exception. He was Michael Jordan. He was Mozart. And the brutal, statistically proven truth is that most fund managers are not Peter Lynch. For every one manager who beats the market over the long term, there are dozens who fail. And they don't just fail by a little. They fail spectacularly. There's a famous report called the Spiva Report, S&P Indices versus Active. Twice a year it does the one thing the active fund industry hates: it keeps score. It compares the performance of thousands of actively managed funds against their passive index benchmarks. And the results are devastating. Over a 15-year period, more than 92% of large-cap US stock funds failed to beat the S&P 500. Let me say that again because it's the single most important statistic in this entire debate. Over 92% of the highly paid, brilliant Top Gun pilots failed to outperform the boring, cheap commercial airliner on autopilot. Why? Why is it so hard? 2 reasons. First, that fee hurdle we talked about. It's like starting a 100-meter dash 10 meters behind the starting line. You have to be significantly faster just to catch up, let alone win. Over decades, that fee difference compounds, eating away at your returns like a termite infestation. Second, the market is incredibly efficient. There are millions of other smart people, armed with supercomputers, all looking at the same information at the same time. Finding a truly undervalued stock, a $20 bill lying on the sidewalk, is unbelievably rare. By the time you spot it, chances are 1,000 other people have already analyzed it, priced it in, and the opportunity is gone. So, is active management a complete scam? A lost cause? Not entirely. But you have to be incredibly selective and understand where it can work. Active managers have a better chance of succeeding in less efficient, less trafficked corners of the market. Trying to beat the S&P 500, which is made up of the most heavily analyzed companies on planet Earth, is like trying to win a hot dog eating contest against a professional. But in other areas like emerging markets or small cap stocks, or certain niche bond markets, a skilled manager with on-the-ground research can still find an edge. Information is less perfect, and there are more hidden gems to be found. The other potential advantage is downside protection. This is key. An index fund, by its very definition, is a full-time passenger. If the market plane is going down, the index fund is strapped into its seat and going down with it. A skilled active manager, however, can see the turbulence ahead. They can sell off risky stocks, move into more stable assets like cash or high-quality bonds, and deploy the parachutes. They might not go up as much in a roaring bull market, but their goal is to lose you less money in a terrifying bear market. For a more conservative investor, that peace of mind, that potential for capital preservation, can be worth the higher fee. So, who is the actively managed fund for? It's for the researcher, the believer. It's for the investor who doesn't accept that average is good enough. and is willing to put in the hard work to find a truly exceptional manager, to read their letters, understand their philosophy, and stick with them through good times and bad. It's for the strategist who wants to target a specific, inefficient market where skill can still win the day. And it's for the cautious investor who prioritizes a smoother ride and is willing to pay a premium for a human pilot they trust to navigate through the storms. We've now covered the 4 major food groups of the investing world. We have the building blocks of growth with stock funds, we have the stable foundation of bond funds, and we have the 2 great competing philosophies, the low-cost, automated efficiency of the index fund, and the high-octane star-powered potential of the actively managed fund. You could build an incredible diversified portfolio just by picking and choosing from these 4 categories. But what if you don't want to pick and choose? What if the idea of balancing stocks and bonds, of reallocating your portfolio every year, sounds like a massive headache? What if you want a single all-in-one solution that does everything for you? A fund so simple it's practically foolproof, designed to automatically grow with you, and then protect you as you near your biggest financial goal. For that, you need to know about the final and perhaps most revolutionary type of fund we'll discuss. It's called the Target Date Fund, and its entire existence is based on one powerful, life-changing idea. Your single biggest risk factor as an investor isn't a market crash or a bad company. It's you. It's the risk that you'll forget to adjust your portfolio, that you'll be too aggressive when you should be safe or too safe when you should be aggressive. The Target Date Fund is designed to save you from yourself. Here's how this brilliant yet simple concept works. When you look at these funds, they always have a year in their name. A Target 2050 fund, a Target 2060 fund, a Target 2035 fund. That year is not random. It's the approximate year you plan to retire. You simply pick the fund with the year closest to your own retirement date, and the fund handles literally everything else. It is the ultimate set-it-and-forget-it investment. Inside that single fund is a fully diversified portfolio of other funds, thousands of stocks and bonds from all over the world. But here is the magic, the revolutionary part. The fund automatically and gradually changes its own investment strategy over time, following a preset path called a glide path. Think of your investment life like a long flight. When you're young, say in your 20s or 30s, and you pick a 2060 fund, your retirement is decades away. You have a long runway. You can afford to take risks for higher rewards. So the fund acts like an aggressive equity fund. It might be 90% stocks and 10% bonds. Its primary mission is growth, growth, growth. It's taking that plane as high and as fast as it can go to cover the maximum distance. Now fast forward a decade or two. You're in your 40s or 50s. Retirement is no longer a distant concept. It's on the horizon. A market crash now would be much more painful than it was 20 years ago. The Target Date Fund knows this. Without you lifting a finger, it has been slowly, methodically selling off some of its stocks and buying more bonds. That 90-10 split might now look more like 60% stocks and 40% bonds. It's starting its descent. The fund is transitioning from a pure growth engine into a balanced fund, seeking to protect the wealth you've already built, while still capturing some growth. Finally, as you approach that target year, 2060 in our example, the fund makes its final transformation. It becomes a conservative income and capital preservation fund. The mix might be 30% stocks and 70% bonds, or even more conservative. The plane has landed. The goal is no longer to climb higher, but to sit safely on the tarmac, protecting its precious cargo, your retirement savings, from turbulence. This automatic rebalancing, this glide path, is what makes Target Date funds so powerful for the average person. It automates the single most important strategic decision an investor has to make over their lifetime: how to adjust risk as they age. You don't have to remember to do it. You don't have to debate when to do it. The fund's very structure is built to do it for you year after year. This is why you see Target Date funds as the default option in so many American 401k plans. For the person who doesn't want to become a stock market expert, who just wants to save diligently for retirement and know their money is being managed intelligently, it is arguably the greatest financial innovation of the last 50 years. But, as with everything, it's not perfect. The biggest critique is that it's a one-size-fits-all solution. The fund's glide path is based on an average person retiring in that target year. It doesn't know if you have a high risk tolerance and want to stay aggressive longer. It doesn't know if you have a huge pension and can afford more risk. It doesn't know if you're terrified of the market and want to be more conservative. You are on its path whether you like it or not. Furthermore, because you are paying for this automatic management service, Target date funds can sometimes have slightly higher expense ratios than if you just bought a simple stock index fund and a bond index fund yourself. You're paying a small premium for the convenience of never having to worry about rebalancing. For millions, that trade-off is well worth it. So let's take a step back and look at the entire landscape we've just explored. We have decoded the 4 fundamental building blocks of the mutual fund universe. First, we have equity funds. These are the engines of wealth creation. They buy stocks, ownership in companies. They are your tool for aggressive long-term growth. They are the high-octane fuel designed to get you to your destination, but they come with the highest volatility and risk. Second, we have bond funds. These are the shock absorbers. They are the braking system. They buy debt, lending money to governments and corporations. Their job is not necessarily to make you rich, but to keep you rich. They provide stability, income, and a cushion against the wild swings of the stock market. Third, we have the hybrid balanced funds. This is the prepackaged compromise, a static mix of stocks and bonds in a single fund, trying to give you the best of both worlds. Some growth from equities, some stability from bonds. It's a simple, diversified starting point, but one that doesn't change with you. And finally, we have the automated pilot target date funds, the dynamic solution, the fund that starts its life as an aggressive equity fund, morphs into a balanced fund in middle age, and lands as a conservative bond fund in retirement. It's the fund designed to manage your entire investment life cycle for you. Understanding these 4 types is not about picking one and ignoring the others. It's about understanding what tools you have at your disposal. A sophisticated investor might use a low-cost equity index fund in their Roth IRA for maximum tax-free growth, hold a municipal bond fund in a taxable account for tax-free income, and let a target date fund manage their 401k on autopilot. They are all tools for different jobs. The point of this entire journey was to arm you with a new language, the language of investing. Now, when you look at your retirement plan options, those names and descriptions are no longer intimidating jargon. You see large cap growth fund. And you know that's an equity fund, it's for growth, it's higher risk. You see short-term corporate bond fund. And you know that's for stability and income, it's low risk. You see a Target 2055 fund. And you understand its entire 30-year mission in an instant. This is not trivial knowledge. This is the foundation upon which financial freedom is built. It's the difference between being a passenger, passively hoping your money grows, and being the navigator of your own financial destiny, making informed, confident decisions. You now understand the fundamental choices that will shape your future wealth more than almost any other decision you make. You've replaced confusion with clarity and fear with a strategy. If this unlocked a new level of understanding for you, if it made the complex feel simple, then our mission here is just getting started. This knowledge is too important to keep to yourself. Share it with one person in your life, a friend, a family member, a coworker, who you know is trying to build a better future. And make sure you subscribe because decoding the market isn't a one-time event. It's a journey and yours has officially begun.